We've got two special guests joining in for that chat. Harish Krishnan of Kotak Mutual Fund, and also joining in Karthik Raj Lakshmanan of PNB Paribas Mutual Fund. Gentlemen, thank you so much. It's not very often that we get two fund managers on the show, so we're going to capitalize on this and, really pick your brains on some market strategies that our viewers could benefit from. Harish, you go first. Let's, first talk about what you've made of this pretty decent sharp up move that we've seen so far. Would you say that it's only to do with the budget, or are inherently the internals of the market now actually looking a lot healthier?
So I guess the fact that there have been no negative surprises is possibly the biggest positive surprise as far as market participants are concerned. The second thing is, of course, there's been a deluge of flows, and this we've been saying it for some period of time, that this has been from physical assets to financial savings, and this budget, of course, does tinker with some of the investment income as far as taxes are concerned from the real estate part. So that again augurs well for financial products, including equity funds. Thirdly, I think more reassuring from a budget perspective was the fact that they have stuck to a reasonable time frame as far as fiscal budget and gross borrowing is concerned, and therefore the fear of say interest rates rising, etc., are put to rest. The cost of capital is reasonably low. You've got an earnings growth for the last 3-4 years, which has been mediocre to say the least, and therefore you have a coil of earnings which can potentially come through over the course of the next 3-4 years, which could therefore be where equity markets are getting interesting.
Karthik, what are your thoughts? You manage the two large funds, one of course the blue chip fund and also the tax saver at BNB Paribas. If one were to look at your overall funds, which are the areas you are overweight on right now, and what have you been adding in the last 2-3 months, which you have disclosed as far as the fact sheets go? Which are the sectors you have been nibbling into?
So the key overweight for us has been financials. I mean, within financials, we've been largely overweight on the structural theme of the retail lenders, whether it is retail banks or the NBFCs. To add to that, we've had a few corporate banks as well, where we feel the asset quality issues kind of have been recognized and the resolution is on its way. So to that extent, overall financials is something that we've been positive on. That's our key overweight as such. Besides that, what we are overweight on is materials. Within that, the domestic consumption story or cement is something that we've been overweight on. The demand supply scenario looks very good, and that's where we have been positive on the sector. Besides that, we would have added bottom-up metal names in the last couple of months or so, where either there is a supply discipline or the kind of the companies have good growth story and deleveraging as well. So it's more bottom-up within metals, which we are positive on. And utilities is something that we are clearly positive on. As the interest rates come down, these are utility companies with good earnings visibility, good stable earnings visibility. That's something we are very positive on.
Harish, a lot of people are amazed at the speed at which market has gained weight. First, it was the Trump-triggered rally of 400-500 point. Another 200-300 got added because of the long-term capital gains was untouched. Do you think market has made a slight departure from fundamentals, and it's only because of liquidity? And fund managers like you, are you finding it difficult in this kind of a market, which is not backed by earnings in the correct sense, to find value and pick stocks?
So see, it is a polarized market. There is no doubt about it. There are sectors, which are, I would say, significantly below long-term averages. But it's not without reason. Clearly, the near term, for example, as far as exporters are concerned, the near term headwinds are quite significant, and therefore you've got some pockets of value, deep value out there. You've got on the other extreme, you've also got some fantastic compounders and franchises which are on the consumer side, which because of the demonetization and the scare that maybe the growth or the headway of a growth has got impacted, came to some attractive levels, and obviously they've scaled back most of the losses that they've done. But so I would not say that valuations have reached some scary levels or crazy levels which make us very uncomfortable. But we would think that this sets a base for the market to take off from here. But it's going to be a bit more gradual. It's not going to be a V-shaped takeoff that if you don't put in all your money right away, you're going to miss the entire rally up front.
Karthik, let's talk about some of the stocks that have sort of been in the news for not the right reasons, and that's largely IT and pharma companies, because there's this fear that the rhetoric that was part of Donald Trump's poll campaign, so it were, is actually now turning into reality. Would you sort of stick your neck out and take a contra call and look at maybe investing in some of these companies at these levels, or would it be just the way we're seeing the market do it, which is just keep clear?
So information technology is something that we've been underweight. Here the dynamics have changed. The growth on a large base, and the way kind of the customers have been, the clients of the large IT companies have been asking for a bargain as far as the price is concerned. We've seen a pricing pressure as well. Given this, the earnings growth in these companies are going to be lower, and probably in single digits to just about double digit. So that's where this is something that we've been avoiding or have had an underweight stance. So that still continues.
Right. Harish, what about you? Let's look at it this way. What are the areas that, say, in the last couple of months you've increased your exposure to, and which are the ones that you think, it's better off to steer clear?
So in a way, we are pretty boring investors. We tend to look at markets from a 3-year horizon or a cycle perspective. Churn or turnover rates in our funds are reasonably low. So within that context, I think we've done little amount of tinkering. What we've added, especially during the fall from November to December, was primarily buy into rural franchises. We believe that the rural theme is quite strong. And the government has clearly articulated that in the budget in terms of increased allocation and spending there, and that was a theme that we played on. The second thing was, as far as oil and gas, especially on the gas side, we believe there is a reasonable amount of tailwinds in that sector. It's a cleaner fuel. The government is also pushing it across the range of board. That's a space which we see can have a tremendous amount of value creation over the medium term. The third area that we added in was primarily from unorganized to organized, and this has been one of our favored themes over the last multiple years. But I think like I mentioned before, when demonetization happened, a lot of these franchises came down to reasonably very strong valuation levels, and we added on to our exposure in a lot of those companies and sectors which are a big beneficiary of unorganized to organized. So these were the 3 or 4 broad areas where we've added exposure.
We are almost 75% done with the third quarter numbers, and they've been actually slightly better than what the street was estimating, though not everybody on the street is believing those numbers, saying it may be adjustment one-off, but the real hit may actually come in the fourth quarter. What are your thoughts on this, and by when do we actually see broad-based, full-blown earnings recovery, say even 2-3 quarters far out? By when do we see that start happening in the system?
Yeah, I think it's a excellent question. Headline numbers are definitely better than I think the fear that a lot of market participants have had as far as Q3 is concerned, whatever has been reported so far. But this also comes on a very depressed base of Q3. If you recall, going back to the last year, banks had a washout quarter. You had commodity companies bleeding in red, And from that perspective, obviously there is an optical base which actually helps our case as far as Q3 is concerned. So you're right that we need to see better quality of earnings and better breadth of earnings. I think the breadth is reasonably there. We're seeing a lot more. The leadership is just not limited to one sector or one category of companies, and this I'm talking about the broader index. I'm not necessarily talking only about the large cap. So which I think augurs very, very well, because we want a lot more sectors to participate in the broad base, in the broad basing of earnings growth, and we're starting to see that. Our hunch is that Q4 will continue with this trend, but it's going to really be that festive quarter again, which pushes us back into post monsoon period of FY18, that we really think where earnings will hit a crescendo of sorts.
Karthik, last year the DII community really cushioned the market a whole lot in terms of flows, while the FIs started faltering the last 2 months. Now FIs have started coming back, at least the last a week, 10 days. How do you see the flows situation pan out in rest of 2017?
So if we see last many years track record, FIs have been net buyers barring probably 1 or 2 years as such. And India is still one of the best growth stories across emerging markets, and the quality of growth, the kind of companies that you would get to invest into. So long-term investors or long-term FIs definitely will come back, and FI flows from a longer-term perspective should be positive. It is difficult to kind of put a point and say, it's going to be positive at this month or this quarter, but definitely from a longer-term perspective, we believe FI flows would be positive. But also not to forget, in the last couple of years, we've seen that domestics themselves have kind of contributed significantly. The mutual funds have had huge inflows into their funds, and that itself has supported the DII flows. And so that's even the case in point is the last 3 months when FIs actually had kind of outflows, but the domestic flows have supported the markets.
All right, gentlemen, we leave it at that. Harish and Karthik, thank you so much and have a great weekend. Appreciate you taking time out for us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.